So let's get started with Bollinger Bands and smart trading using Bollinger Bands. Now, one of the interesting things about Bollinger Bands, they were created by John Bollinger, hence the name Bollinger Bands. But it's one of the few indicators that the actual developer is still active in the markets, and John Bollinger actually runs a very active website called Bollinger Bands. So if you want to really learn about all the ins and outs of Bollinger Bands, you can actually go to the website for the man who created them. And you can read on there all about how John Bollinger developed these. Now, when he developed them, they were developed from a much slower market for the stock market. He's made lots of adjustments over the years. And today they work beautifully for online trading in short-term markets, and they work for crypto as well as they work for currency pairs, as well as they work for commodities. They're a great tool for trading CFDs. Now, there's an abundance of information published on how to trade with Bollinger Bands. Much of it, though, is discretionary in theory. It's all about some guru's idea of how you can use Bollinger Bands. But the how to use Bollinger Bands information usually pushes it back to the trader, you, to interpret what an asset's price is doing relevant to the bands. Now, Bollinger Bands can be applied in all the financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames from very short-term periods to hourly, daily, weekly, and monthly. Now, when Bollinger developed these bands, they answered primarily one question: are prices high or low on a relative basis? Now, by definition, price is high near the upper band and price is low near the lower band. Now, that one little bit of information is very valuable. But us online traders want a lot more out of our indicators than those simple questions answered. So Bollinger Bands are a technical analysis tool. Specifically, they are trading bands or envelopes. And trading bands and envelopes serve the same purpose. They provide us relative definitions of high and low. Bands are usually thought of as employing a measure of central tendency as a base, such as a moving average. Now, we're going to go over to live charts and look at this soon, but you got to listen to this mumbo gumbo because you have to understand about Bollinger Bands. Now, a Bollinger Band consists of a middle band, which is based on a moving average. It's based on a 20-period moving average. Then it forms what we call an upper and lower band above and below the moving average that are done using a statistical formula called standard deviation. And thus it incorporates volatility. The general principle is that by comparing a security's position relative to the bands, a trader may be able to determine if an asset's price is relatively low or high. Further, the width of the bands can indicate how volatile the markets are. So where do we start? Well, Bollinger Bands are typically charted over a 20-period moving average. Some traders make the periods days, others prefer a shorter look-back period. It basically adjusts. If you're looking at a 15-minute chart, it's a 20-period moving average using 15, 20-minute periods. Looking at a 1-hour chart, it's back 21 hours. So let's go over to a live chart. Let's see what we're talking about here. Okay, so Bollinger Bands starts out, let's make this a 1-hour chart just for class. Now, this is my standard teaching chart. It's the Euro US dollar. There is no reason I picked it for today's class. I'm not advising on trading the Euro US dollar. I use this chart for every class I teach. Now, what we have running through here in the dark brown is a 20-period moving average. Okay. Doesn't tell us much. Now, if you trade from moving averages, remember, we have red light, green light. Prices over top of the moving average, we should be looking at a long position. If prices below the moving average, we should be looking at a short position. But a moving average is a real bare bones indicator. Okay? But it is the center line for our moving average. for our Bollinger Bands. Now, from this point forward, now it doesn't matter. When you go to your indicators line and just drop on Bollinger Bands, it's going to do all this for you, but you need to know where the lines come from. From there, we drop on what's called the upper line and the lower line, or the upper band and the lower band. These are the green upper and lower lines on the chart now. And these are calculated as 2 standard deviations from a moving average. And yes, in today's class, you're going to have to learn what a standard deviation is. And I'm going to spend some time trying to explain it to you, because you have to understand where these lines come from in order to know when the bands are working for you or against you. Now, again, all of this is dropped on your charts for you very easily by the computers. And that's one of the biggest faults in today's market. Too many people just drop an indicator on there, never learn what it all comes from, and just says, oh, when RSI is over this borderline, it's overbought. When it's below, it's oversold. But unless you understand all the mathematics that go into this indicator, you don't understand when it's giving you good signals or bad signals. You don't understand what it's trying to tell you. You're just trading robotically. So the first thing Bollinger Bands tells us, and gives us when we drop it on our chart, is we're not concerned with this greened in background area. What we're concerned about is the relationship between price and the moving average, the relationship between price and the upper and the lower band. Sometimes this squiggly form looks like an alien. Sometimes it looks like some snake or creature. It doesn't tell us anything. Now, what we do get from the Bollinger Band is, number one, the more the separation between the upper and the lower band, the more volatile that asset is. When the bands are relatively narrow, means the market is not active. It's trading sideways. Now, just like all markets, when price moves sideways for a while, it's eventually going to start trending up or down. And we have things like riding the bands and crossing the moving averages. But first, you're not going to get away with it. We've learned how to put the Bollinger Band on the chart. And we know this line is a calculation of 2 standard deviations of the moving average. This line is minus 2 standard deviations of this moving average. Now, we're going to have to learn what standard deviation is. I know all of you are making faces at me at the moment. But interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, by calculating by hand, it's very, very slow. This is why statisticians rely on spreadsheets and computer programs to crunch numbers. So I'm not expecting you to do any math. So now you can smile again. But you have to understand the concept. So the calculation of standard deviation is the measure of dispersion of a set of data from its mean. It is calculated by the square root of the variance by determining the variation between each data point relative to the mean. If the data point is further from the mean, there's a higher standard deviation within the data set. Okay. Did anybody out there actually understand what I just said? I'm telling you, I've been teaching this class for a long time, and it took me a long time to figure this out. It's a lot of confusing words, and I actually have an undergraduate degree in mathematics and a graduate degree in taxation and finance. Okay, but I still had to figure this out. So let's try to explain it in easy words so that you can get some understanding of what we're trying to talk about. So standard deviation is a measure of the spread of the data set of data. What's the data set? It's the open, the high, the low, and the close of the asset for each one of those points. So we're looking at a 1 hour chart. It's the open, the high, the low, and the close for the 1 hour, or it's the dispersion of that set. Now, wouldn't it make sense to you if the open and the high were very far apart? Okay, and the open and the close were very close. That tells you something, because the dispersion from the low to the high is very, very important. But also, the difference between the open and the close is also very important. So it calculates the dispersion of that data set, or the open, the high, the low, and the close, from what's another word for mean? From its moving average. So if you had a moving average, say that was here, and you had a data set, the open, the high, the low, and the close, and the open was here, I mean, the high was there, the low was there, the open was there, and the close was here. Well, all of those calculations, that dispersion of that set from its moving average, well, that's very important, because look at this time. Here we had a huge high way above the moving average. It closed above the moving average. It opened up just about. Now, it did dip down. Well, that calculation tells us an awful lot about what happened in that time frame. So the math behind it is quite complicated. Okay. But it is a statistical measurement. Now, in its simplest form, the mean is simply the average of all the data points in the given set. In investing, for example, you might want to know the mean or the average closing price for the last 20 days or last 20 periods. That's the moving average. This can be obtained by adding the closing price for each session and dividing it by 20. Now, because markets are fickle at best, traders and analysts use moving averages to adjust daily to incorporate the most updated data. This means the calculation is always taking into account the most recent trading sessions movements, and older sessions drop off as they become relevant. An EMA, an exponential moving average, is calculated by weighting each data point and giving greater significance to the more recent points. So Bollinger Bands, by default, is based on a set of 2 standard deviations. Okay, so we have the moving average line, here, and we have 2 standard deviations above to form an upper band, and 2 standard deviations below to form the outer band. So that's not so difficult, was it? Now we got done a chart, we actually understand the calculations. So what happens is, when the data set deviates a great deal from the moving average, what do we usually have? We usually have the start of a trend, or price trending up, because as price trends up, the moving average is falling behind it, and as price is moving up, how does a price make an uptrend? Higher highs and higher lows. Okay, so those two numbers are moving farther and farther away from the moving average, and they're a bigger dispersion, so your bands are getting wider. So standard deviation is calculated based on the average. The distance between each data point is squared, summed, and averaged to find the variance. Or to put it another way, variation is derived by taking the mean of the data point, subtracting the mean of each data point individually, squaring each of these results, and then taking another mean of those squares. Standard deviation is simply the square root of variance. Okay, we're not going to discuss it anymore. So Bollinger Bands are based on the middle band, an upper band, and a lower band. That's it. So let's translate that all into action. Now, Bollinger Bands serves three primary uses. We have pattern recognition, and for Bollinger Bands, it's simply like double tops or double bottoms, but what we call a W and an M formation. It also gives us reversal signals that identifies early warning signs of reversals, and it gives us trend analysis. It helps us see whether the trend is continuing or concluding. Now, there are many ways to use Bollinger Bands, and it's important to note that when the price touches the upper band, that doesn't automatically mean sell. Similarly, if the price touches the lower band, that does not mean buy. In fact, take it from John Bollinger himself. There's absolutely nothing about a tag of the band that in itself is a signal. So price can walk up a band during a strong downtrend or an uptrend. This means that there are repeated instances of a price touching or breaking through the lower or upper band. But price usually rides on that band during an uptrend and rides on the lower band during a downtrend. So what we call riding the band is during an uptrend or a downtrend, we would expect price to ride on this lower band. Here we have it twice in a downtrend. During an uptrend, we expect price to move to that upper band and ride on that upper band. Here we don't have it, so we don't have actually a ride. So we wouldn't be looking, we don't actually have a developed trend. Now, the key to Bollinger Bands is its relationship between the upper band, the lower band, and the moving average. If you use Bollinger Bands long enough, you'll learn to trust the bands. What we're looking for during an uptrend is first, how do we know we have an uptrend? Price moves up away from the lower bands. When it breaks the moving average, then we can think that price is moving to an uptrend. Then we're going to look for it to move on the upper band. When price tries to touch the upper band and is rejected, that can happen quite often. But when it's rejected a second time, that's telling you really don't have the makings of a trend. Okay. Now, we still have upward movement, and you would not even think that this trend is ending until you have a break of the moving average. Okay. In this case, like I said, we had actually no uptrend. We have price moving a little bit upward, but we didn't have. Here we saw price break the moving average, move to the band, and ride the bands downward. This was a beautiful downtrend move that we could have captured. Again here, break of the moving average, come down to the bands, and ride the bands backwards. Now at this point, we aren't sure because it is being rejected by the outer band. That means price isn't reaching the outer band. And then we had an upward. We're not sure whether it's a retracement, a reversal. We're not sure of anything. But the minute it breaks this upper band, the minute it breaks the moving average, we would want to be out of the market because it tells us that this downtrend is over. So we might have wanted to enter somewhere around here, and we would have definitely gotten out of here. We wouldn't have made much money, but we would have had a successful trade. Again here, okay. Unfortunately, this was a very volatile move, so you wouldn't have realized that it broke the moving average until this point, and here it's not riding enough, and it's being constantly rejected. Okay. So you need to see a clear movement of the bands and the relationship between the outer band, the upper band, and the moving average to make any type of trading decision. Now we also get what we call pattern formation. Pattern formation is a W and an M. Unfortunately, they're like head and shoulders. They take a long time to see, and by the time you notice them, they might be over. Okay. An M or a W, let's go back to my PowerPoint. hold on a second. So we'd be looking for what we call the classic M or the classic W. One's a reversal of the other, one's coming off of an uptrend, one's coming off of a downtrend. But with a double bottom, you note that the first time that the price touches the low band and then waits there to see, the next low occurs relative to the band. So with a double bottom, we have price moving in a downtrend. Here we have it riding the bands, price is actually moving in a downtrend. It gets rejected from the outer band and moves up. We have no idea it's forming any type of pattern at this point. Comes above and forms a top here, or what we call a neckline that we would see in a head and shoulders, and then price moves back down again. It forms a bottom, a second bottom equal to the first bottom. Then it moves up. We have no idea that this is now confirming a move to an uptrend until it breaks the moving average. When it moves up and forms the final part, first we had an N formation. This is the upside down N coming off of a downtrend. At this point, we have no idea what's going to happen, but the minute it breaks that moving average, we actually have that W formation and we have a buy opportunity. We have just the exact opposite when we form an M formation coming off of a top. So here we come off of an uptrend. Forms a top, comes back down, forms a neckline, comes back up and makes that second top equal to the first top, comes back down. When it breaks this moving average, we would have a very strong buy signal. Now, like I said, it's hard to notice because they take a long time to develop, but if you don't have to notice them until they're, it's coming up to that moving average and breaking above or breaking below. Okay. Then you can go back and look and say, I had an M or a W. Now, Bollinger Bands works really good with other indicators. It is a happy couple when you couple it together with RSI. It's like the perfect match. Now, there's a trading strategy using Bollinger Bands called 3 pushes to high. Tops often develops as a leading edge of a larger, longer topping formation. Typically, the way it forms is like first. The first push will make a new high outside the upper band. The second push will make a new high and touch the upper band. And the third push will make a new high, but will be within the band. So you have a push up, makes a new high. Not on the band, it makes a new high on the chart. Okay. And then comes back down and then pushes back up. Now the new high touches the band, but it doesn't break out of the band. The third high, then it eases back down. The third high will make a new high on price chart, but it doesn't touch the upper band. It's still within the upper band. Because remember, those bands are continually moving as well as price. So here we have a three time period activity. And at the same time, we have a relationship to the bands. So the first band pushes outside the upper band, making a new, and it also makes a new high. The second makes a new high, but the band is expanded higher than that, and it touches the upper band, but it doesn't break through it. The third price point, the third segment, the third time frame, makes another new high in price, but the band has exceeded out, the band is growing wider, and so it actually doesn't touch the upper band, even though it's a new high for price. So you can see it here on this chart. And then, as I mentioned, we have walking the bands. Walking the bands, so when price walks down the band or walks up the band. Just because price touches an upper or lower band, it does not necessarily mean there's a signal. A mistake some traders make is that they try to teach any drag of the band as a trigger, but actually it is a sustained uptrend. There will be repeated touches of the upper band and vice versa. In a sustained downtrend, there will be repeated touches of the lower band, with some closes below it in a decline. And this is called walking the bands. The price stays on that band. It's not till you get a second rejection where price is riding the band and then comes back into the center of the bands and pushes down, but can't reach that band again. And then again, a second time, tries to reach that band, is rejected by the band, that you have something. Bollinger Bands can also indicate the ends of strong trends. Strong trends cause an expansion of volatility that will cause the band to initially move apart, meaning the lower band will actually move down opposite the trend. When a trend begins to wane, the lower band in the uptrend will turn back up, which can be a signal that the move might be over, at least for a while. Volatility tends to be mean reverting. Periods of low volatility are generally followed by high volatility and vice versa. When the bands are narrow, it is called a squeeze. The price is being squeezed into that narrow band. We see it in triangle patterns when price is being squeezed into that apex of a triangle. It means that volatility is low. But remember, since volatility is mean reverting, the bands will probably expand, signaling a potential for an explosive move. A simple way to spot a squeeze is when the bands are narrowest and they have been there for a while. So when bands are narrow and they've been there for a while, we know that prices sooner or later are going to explode. We don't get a directional signal. What we do know is that price is going to explode out of that band one way or another. So we're going to be looking for a break. So when trading the squeeze, you might consider placing a buy entry point above the upper band and a sell entry point below the lower band in a squeeze area. For buys, consider placing an initial stop under the lower of the breakout formation or under the lower band. For sells, consider placing your initial stop above the high of the breakout. Then, to exit the trade, consider using a trailing stop or a fixed dollar percentage. So we can see here on this chart that the role of moving averages is crucial. Okay, you do not get a move one way or another, a confirmation of a move, until it breaks the moving average in the center of those bands. During trends, the moving average holds very accurately, and a break above that moving average is usually a meaningful signal that the sentiment has shifted. So, as you see here, price is riding that upper band, moving nicely. It eases back down, but you see it doesn't break the moving average. Moves back up to ride that upper band. Now we see price here being rejected twice by that upper band, and price moving down to that moving average. It could move back right up, but when it breaks that moving average, we know that this uptrend is now over, and it signaled us that prices are tending to move to a downtrend. As soon as it starts to reach that lower band, we have a very good sell opportunity. So while Bollinger Bands are exceptionally helpful in determining when an asset has overshot to the top side or downside, it is important to use the bands to also set risk conditions, not just entry conditions. So remember, the bands expand and contract by volatility. The more volatile a market is, the wider you have to set your stop loss. So additionally, risk and reward should be set based on the width of the bands or volatility, with narrower risk rewards during low volatility and wider risk rewards during higher volatility. So in contrast to most indicators, the Bollinger Bands are a non-static indicator. Bollinger Bands are constantly adjusting moving forward, and they change their shapes based on recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of trends and get a lot of important information this way. So there are just a few things we need to pay attention to. During strong trends, price stays close to the outer bands, upper or lower. If price pulls away from the outer band as the trend continues, it shows fading momentum. Repeated pushes into the outer band that don't actually reach the band show a lack of power. A break of the moving average is often the signal that the trend is ending. So we can see here a whole story of an asset. But the fact is, looking back and historically how the asset moved doesn't help us moving forward. All we can do is learn how to read the bands moving forward. So here we see price moving, rejected by the band, moving now, breaking the moving average, going to downtrend. Now we see it pulling away from the lower band. And we see it now against the wall, breaking above the moving average. This would tell you that we're ready for a buy opportunity. If we were in the market, we'd also want to be exiting the market. So you can only look at price action at the wall relative to the bands and the moving average at present. So as you can see, Bollinger Bands can be useful by themselves. But remember too that they can be combined with other indicators. Since they are a pure price indicator, you might want to consider combining them with volume indicators for even more depth or insight. Ultimately, there's no indicator that guarantees you always get into the bottom or the top of the market. However, Bollinger Bands, especially when paired with other indicators, such as chart pattern recognition tools, can help you make better trading decisions. So there's a preciseness here using Bollinger Bands in this way, using the preciseness to your advantage. Now, we talked about all the techniques. We talked about the Bollinger Band bounce. We talked about the squeeze. We talked about the MCW. Talked about riding the bands. So there's a whole bunch of techniques that you can use to add Bollinger Bands into your charts to make smart trading decisions. Thank you very much for joining us today. And if you want to learn more, go to www.alvexo.com and visit their education center or use their live chat window, and somebody will be glad to answer your questions. So have a great trading day. Thank you for supporting Alvexo, and thank you for being part of our webinar. Bye now.